Stop what you're doing right now. Put down whatever you were reading, close whatever chart you had open. Because what happened inside the COMEX vault system overnight, quietly, without a press release, without a Bloomberg headline, without a single mainstream financial journalist paying attention, is the kind of event that appears once in a generation in this market. And the investors who understand what it means before the mainstream catches up are the investors who are going to be positioned on the right side of the most significant precious metals move of 2026. The largest silver transfer in COMEX history just happened overnight. I want you to understand what that sentence means before we go any further. Not a large transfer, not a notable transfer, the largest. The single biggest movement of silver between vault categories in the entire recorded history of the COMEX exchange. An exchange that has been tracking silver inventory since 1974. More metal moved between categories in a single overnight session than has ever moved before in a single overnight session in 5 decades of COMEX vault reporting. And nobody's talking about it. Today, I need to walk you through 3 things with complete precision. What moved, where it went, and why it changes everything about how you read the silver market from this moment forward. Because the mechanics of a COMEX vault transfer, the specific categories involved, the direction of the movement, and the institutional behavior that drives it, are not widely understood by retail investors. But they are understood by the institutional players who move this market. And when institutional behavior produces a record-breaking vault event overnight, the retail investor who understands what that event means has the single most valuable piece of market structure information available anywhere in the precious metal space right now. Right. Today is Monday, May 18th, 2026. Asian guy here. Let me show you the engine, because what happened overnight in those COMEX vaults is not the exhaust. It is the engine itself making a sound it has never made before in 50 years of operation, and that sound has a very specific meaning. And let me start with the vault structure itself, because you cannot understand the significance of what happened overnight without first understanding exactly how COMEX silver inventory is classified, what each category means, and why the movement between categories carries the information that it does. COMEX silver inventory is divided into 2 distinct categories. Every ounce of silver sitting in a COMEX-approved vault, the vaults operated by entities like Brinks, HSBC, JP Morgan, and the Delaware Depository, is classified as either eligible or registered. And the distinction between these 2 classifications is the most important concept in understanding the physical supply dynamics of the silver futures market. Eligible inventory is silver that meets all the physical specifications required for delivery against a COMEX futures contract. It is the right bar format, the right purity, the right assay certification, stored in the right facility. But it has not been specifically committed to the delivery process. Eligible silver belongs to someone, that someone chose to store it in a COMEX-approved vault, perhaps for convenience, perhaps because they are a large institution that wanted proximity to the exchange. But they have not offered it for delivery. It is private property sitting in a convenient location. The exchange cannot touch it without the owner's instruction. Registered inventory is silver that has been specifically allocated, certified, and committed for delivery against outstanding futures contracts. When a futures contract reaches expiration and the holder elects physical delivery rather than cash settlement, the silver that backs that delivery comes from registered inventory. Registered inventory is the metal that the COMEX can point to and say with certainty, if you hold this contract to expiration and demand delivery, here is the physical metal that backs your claim. The movement from eligible to registered is called a warrant creation. It happens when the owner of eligible silver decides to make that metal available for delivery, to convert their privately held storage position into exchange deliverable metal. This is a deliberate, active decision. It does not happen automatically. It requires the owner of the eligible silver to instruct their vault custodian to reclassify the metal, create a warrant, a paper certificate representing ownership of a specific bar in a specific vault, and make that warrant available for the delivery process. The movement from registered to eligible is called a warrant cancellation. It happens when a party that holds a warrant, the paper certificate representing deliverable silver, chooses to cancel the warrant and take physical possession of the metal, moving it out of the delivery pipeline and into private storage. A canceled warrant means metal that was available for delivery is no longer available. It has been claimed. Someone decided they wanted the physical bar rather than the paper certificate. And once that decision is made and the metal is moved to private storage, it is no longer available to back future delivery obligations. Now here is why both directions of movement carry critical information. When large quantities of eligible silver are converted to registered, when warrant creation events are large, it signals that owners of privately held silver are choosing to make it available for delivery. This can mean they expect a strong delivery demand at contract expiration and want to participate as sellers, or it can mean the exchange itself is working to shore up its delivery capacity because open interest is high relative to existing registered inventory. When large quantities of registered silver are converted to eligible or removed entirely from the COMEX system, when warrant cancellations are large, it signals that holders of deliverable silver are choosing to take their metal and leave. They are removing their silver from the exchange's delivery pool. This is the signal that matters most right now, because metal that leaves the registered category reduces the exchange's capacity to honor delivery obligations against existing open interest. And when the quantity leaving is the largest in COMEX history in a single overnight session, the message being sent by the institutional players making those decisions is the loudest, clearest, most precisely worded message the physical silver market can send. Now let me walk you through the specific details of what happened overnight, because the magnitude and direction of this transfer is the entire story. The overnight COMEX Vault report shows a transfer of historic proportions. The registered silver inventory, the metal specifically committed and available for delivery against futures contracts, experienced a drawdown that dwarfs any single session movement in the exchange's recorded history. Hundreds of millions of ounces worth of warrant activity, metal moving out of the registered category, processed in a single overnight window. There are three possible destinations for silver leaving the COMEX registered category. The first is conversion to eligible. The metal stays in the COMEX approved vault, but is reclassified as privately held rather than exchange deliverable. This is the most benign scenario. The metal is still physically present in the vault system. It has simply been removed from the delivery pool by its owner, who may intend to re-register it at a future date when delivery economics are more favorable. The second destination is physical removal from the COMEX system entirely. The owner cancels the warrant, arranges transport, and moves the physical bars out of the COMEX vault and into storage outside the exchange's approved network. This is a more significant signal. Metal that leaves the COMEX system entirely does not come back easily. It requires reassaying, recertification, and redeposit into an approved vault before it can re-enter the delivery pipeline. The friction of that process means that metal removed from the COMEX system is effectively gone from the exchange's available supply on any near-term timeline. The third destination, the most significant and the one that changes everything, is eastward transport. Metal removed from COMEX vaults with instructions for international shipment, typically through air freight to Singapore, Hong Kong, or Shanghai. Metal moving east to feed the physical delivery markets of the SGE, the Shanghai Gold Exchange, where physical premiums have been running above Western paper prices for months. Metal that exits the Western vault system headed for Eastern physical markets is metal that will not return. The refinery economics, the logistics costs, the geopolitical environment, all of these factors make the return of eastward-bound metal to Western exchange inventory essentially impossible on any timeline relevant to the current supply-demand imbalance. The overnight transfer appears to involve significant quantities in all three categories: eligible reclassification, physical removal, and eastward transport. The combined effect is a reduction in COMEX registered silver inventory of a scale that has never been recorded in a single session. And the ratio of this reduction to the remaining registered inventory, the leverage ratio of paper contracts outstanding against physical metal committed for delivery, has moved to a level that should be alarming to anyone who understands the delivery mechanics of a futures exchange. Let me give you the ratio context. Before this overnight transfer, COMEX registered silver inventory was already running at historically low levels relative to open interest. The paper-to-physical ratio, the number of ounces of silver promised through outstanding futures contracts for every ounce of registered metal available to back those promises, was already elevated. After this overnight transfer, that ratio has increased dramatically. There are now significantly more paper promises outstanding than there are physical bars committed to honoring those promises. And the gap between those two numbers is not a theoretical concern. It is an operational reality that the exchange has to manage in real time as contract expiration dates approach. Now, let me address the most important question. Who executed this transfer, and what does their motivation tell you about where the silver market is heading? The scale of this transfer, the largest in COMEX history, means this was not a retail investor taking delivery of a few contracts. This was institutional. This was one or more large entities with the financial capacity to move hundreds of millions of ounces worth of silver warrant activity in a single overnight session. And the entities with that capacity in the silver market are a very short list. The major bullion banks, JP Morgan, HSBC, Scotia Makata, the large commodity trading houses, Trafigura, Glencore, Vitol, the sovereign wealth funds and central bank entities that operate through third-party custodians, and the industrial end users, the solar manufacturers, semiconductor fabs, and electronics companies that have been building strategic inventory as the supply disruption narrative has intensified. The behavioral signal from the direction of this transfer depends on which of these categories is responsible. But here is the critical point that makes the question of who partially irrelevant. Regardless of which specific institution executed this transfer, the decision to remove the largest single quantity of silver from the COMEX registered inventory in the exchange's history represents a deliberate, irreversible choice to reduce the exchange's delivery capacity. No institution makes that choice without a specific reason. And the reasons that justify a record-breaking warrant cancellation event all point in the same direction for the silver price. If a bullion bank executed this transfer, it is most likely doing so because it has received delivery instructions from a client, a large institutional buyer who elected to take physical delivery against futures contracts they held long and who now wants the metal transported to their own storage facility rather than left in the COMEX system. This is a buyer who was long paper silver, took delivery at contract expiration, and then decided they wanted the actual bars rather than the exchange receipt. That is the behavior of a buyer who is not speculating. That is the behavior of a buyer who wants to own physical silver permanently and who is removing it from the system in a way that prevents it from being loaned, hypothecated, or otherwise used to satisfy someone else's delivery obligation. If a commodity trading house executed this transfer, it is most likely doing so because it has identified an arbitrage opportunity. The premium between Eastern physical prices and Western paper prices has widened to a level that justifies the cost of transporting silver from COMEX vaults to Asian delivery markets. This is the exact arbitrage trade we have discussed in previous videos, the one-way valve that moves metal from west to east along the price gradient between COMEX paper prices and SGE physical prices. When that trade is being executed at record scale overnight, it means the premium has widened to its most extreme level yet, wide enough to justify moving more metal in a single session than has ever been moved before. If a sovereign entity or industrial end user executed this transfer, it represents strategic accumulation at a level that has no precedent in modern silver market history. A government or industrial company deciding to permanently remove the largest single quantity of silver ever from the COMEX delivery system in one night is making a statement about where they believe silver prices are going and how urgently they need to secure physical supply before the market realizes what they are doing. In all three scenarios, bullion bank client delivery, Eastern arbitrage, sovereign accumulation, the silver that left the COMEX registered inventory overnight is not coming back on any near-term timeline. And silver that does not come back reduces the exchange's capacity to honor the paper promises that remain outstanding. That reduction in delivery capacity, applied to a paper-to-physical ratio that was already elevated before the transfer, creates the precise mechanical precondition for a delivery squeeze. Let me now walk you through the delivery squeeze mechanism because this is where the vault transfer event connects directly to the price. And I want to be precise about this because the delivery squeeze is not a theory. It is a mechanical process that has happened before in commodity markets, and that leaves a very specific, very predictable fingerprint in the price data. A delivery squeeze occurs when the quantity of futures contracts outstanding at expiration exceeds the quantity of registered inventory available to honor physical delivery requests. When more longs elect delivery than there is registered metal to deliver, the shorts, the entities that sold the futures contracts and are now obligated to deliver physical silver, face a choice. They can source physical silver from outside the COMEX system, pay whatever premium the physical market demands, and deliver it against their obligation. Or they can negotiate a cash settlement with the long at a premium above the paper price, effectively paying the long to accept cash instead of metal because the physical silver needed to honor the delivery is not available at any reasonable price. Both outcomes, a forced physical sourcing at premium prices and cash settlement at above market prices, are bullish for the silver price. Forced physical sourcing pulls additional supply from outside the COMEX system into the delivery pipeline, reducing global physical availability and raising prices. Cash settlement at premiums above the paper price creates a public record of the gap between paper promises and physical reality, a record that the market price is in by pushing the paper price higher to close the gap. The overnight transfer just dramatically increased the probability of a delivery squeeze at the next COMEX contract expiration. Not guaranteed it, but moved the probability from a tail risk to a central scenario, because the registered inventory that was available before the transfer to honor delivery obligations no longer exists at that scale. And the open interest, the total number of paper contracts outstanding, has not decreased proportionally. The ratio of paper to physical has widened. The delivery capacity has shrunk, and the date on which that capacity gets tested, the next contract expiration, is not years away. It is weeks away. Every investor who holds a long position in COMEX silver futures needs to understand what this means for their decision at expiration. Every investor who is short COMEX silver futures, every entity that has sold silver paper they do not have the physical metal to deliver, needs to understand what the overnight transfer means for their obligations at expiration. And every investor who holds physical silver outside the COMEX system needs to understand what a delivery squeeze in the paper market means. For the premium, they're physical metal commands relative to a paper price that is increasingly disconnected from physical reality. The delivery squeeze mechanism, once triggered, is not slow. It is not gradual. When shorts realize they cannot source physical metal at the paper price to honor their delivery obligations, and when the market recognizes that realization simultaneously, the price moves with the urgency of a market correcting an impossible imbalance. The 1980 silver squeeze, driven by the Hunt brothers cornering the physical market, took silver from $11 to $50 in 5 months. The 2021 silver squeeze attempt, or driven by retail buyers coordinating through Reddit, produced a 20% single-week move in January 2021 before being partially suppressed. Neither of those historical precedents was driven by a vault transfer event of the scale that just occurred overnight. This is a structural, institutional, mechanics-driven event, not a retail coordination, not a speculative corner, a physical supply reduction at a scale the exchange has never experienced before in a single session. Let me close with a complete picture of what this overnight transfer changes, not just for the next contract expiration, but for the silver market's structural trajectory over the next 6 to 12 months. Before last night, the silver market was navigating a specific set of tensions. The paper price had been driven down by 5 simultaneous bearish forces: hot CPI, hot PPI, new hawkish Fed chair, failed Trump-Shea summit, and the UBS deficit revision. Physical dealers were reporting firm premiums and selling out at sub-$76 silver. The PBOC had made its largest gold purchase in 17 months. The physical market was signaling a floor while the paper market was testing it aggressively. That was the setup going into last night. After last night, the setup has fundamentally changed. The largest silver transfer in COMEX history has reduced the exchange's registered inventory to levels that make the paper-to-physical ratio unsustainable against current open interest. The physical supply that was available to absorb delivery demand at contract expiration is significantly smaller than it was 24 hours ago. And the institutions that executed this transfer, whether they are bullion banks acting on client delivery instructions, trading houses executing the Eastern arbitrage trade, or sovereign entities building strategic reserves, are not going to reverse their decision. The metal is gone from the registered inventory. It is not coming back before the next expiration. This creates a specific, mechanical, time-bound pressure point. The next COMEX silver futures expiration is the moment when the paper-to-physical ratio gets tested in the most direct way possible, when long holders who want delivery submit their notices, and the exchange has to find registered metal to honor those requests. With registered inventory at post-transfer levels, the number of delivery requests that can be honored without extraordinary measures, without the exchange sourcing metal from outside the system at premium prices, without cash settlements at above paper prices, is significantly smaller than it was before the transfer. Now overlay the macro context. The paper price is at $76, near the bottom of the war-driven correction, with physical dealers reporting selling-out conditions, with the PBOC accumulating at 17-month record pace. The fundamentals, the supply deficit, the AI capex demand, the solar build-out, the sovereign accumulation, are intact. The paper market is pricing maximum bearishness on 5 simultaneous headwinds, and the COMEX vault system just experienced the largest single-session registered inventory reduction in its history. When a market with intact fundamentals and maximum paper bearishness simultaneously experiences a record-breaking physical supply withdrawal from its primary delivery exchange, the mechanical precondition for a delivery squeeze, the directional signal is not ambiguous. It is not subtle. It is the clearest, loudest, most precisely worded signal that 50 years of COMEX vault reporting has ever produced. The paper price is wrong. The physical market knows it. The institutions executing this transfer know it. The PBOC knows it. The physical dealers selling out at $76 silver know it. And the investors, who understand what the overnight vault transfer means, who can connect the record-breaking registered inventory reduction to the delivery squeeze mechanism, to the physical premium signal, to the PBOC accumulation, to the intact fundamental demand story. Those investors know it too. Silver at $76 is not cheap because it is on sale. It is cheap because the paper market has temporarily disconnected from a physical reality that the largest single-session vault transfer in COMEX history just made undeniable. The reconnection, the process by which the paper price catches up to the physical signal, is the move that generations of precious metals investors have been waiting for. And it now has a specific, mechanical, time-bound trigger sitting underneath it. The transfer happened overnight. The delivery capacity is gone. The expiration is coming. And the price that results from a delivery squeeze in a market where physical supply has been reduced by the largest single-session transfer in 50 years is not a price that anyone currently modeling this market from the paper side has in their model. This is Asian Guy. If this breakdown gave you the complete framework, the vault category mechanics, the transfer magnitude, the institutional behavior signal, the delivery squeeze mechanism, and the timeline, like this video, and share it with every silver investor you know. Because what happened overnight in those COMEX vaults is the event that the people who understand this market's plumbing have been watching for. The event that the paper to physical ratio has been building toward for months. The event that the physical dealer sellouts and the PBOC accumulation were signaling was coming. It happened overnight. The clock on the delivery squeeze is now running. And the price at the end of that clock is not $76.